Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I like interviewing him every couple months now about the oil and natural gas markets. He is truly an expert. I think we could speak for hours about energy, oil, natural gas, coal, nuclear power. He's the founder and chief analyst over at the Capitalist Times. They have a number of oil and natural gas energy newsletters. He's been writing oil and natural gas energy newsletters, I think, for 2 decades now. Elliott Gue, thank you for joining me.
Well, thanks for having me on the show again.
So, Elliot, we're recording this interview on Friday, August 18th, 2023. When we pull up the oil and natural gas prices, we have the West Texas Intermediate crude price above 81, Brent crude price at 84. Natural gas was rallying the last month or so. It's down a little bit to $2.50. I want to get your thoughts, though, with the interest rates, because we've had over 12 months now Federal Reserve Bank interest rate hikes. So cost of capital for all these companies is up. But how, for the industry specifically, how are higher interest rates affecting oil and natural gas producers?
Yeah, well, it really varies upon the producer you're talking about. If some of the smaller players still have quite a bit of debt, so their cost of capital is going to be higher, more dependent upon interest rates. But the larger names, the higher quality sort of larger names, don't have a lot of debt. Mostly nowadays they fund their drilling through operating cash flow. So obviously their cost of capital is much lower. They're not really dependent on public bond markets for a lot of their operating costs, drilling costs. So they're somewhat insulated from it. Now, obviously, there are they do have some leverage to that, partly because for example, when interest rates are higher, a lot of people are buying these producers for the dividend yield, right? So what's happened over the last really 3 or 4 years now is a larger E&P companies, larger exploration production companies have adopted variable cash flow models. So what happens is they usually pay some sort of base dividend, and then they pay a dividend based on their operating cash flow in each quarter, right? So, the benefit of that is it ties your experience as an investor to commodity prices. Commodity prices go up, they make more money, they make more free cash flow, they pay a higher variable dividend. But obviously, the oil and gas business is risky, right? There's commodity price risk. There's inflation risks, cost inflation risks, and as a result, when interest rates go up enough, where you can get a risk-free yield of 5-6%, right? Then the attractiveness of a company like a Pioneer or a Chesapeake that pays one of these variable dividends, it's not quite as attractive to get a slightly fatter yield from these players, given that you also are taking on a lot of commodity price risk. So there is some competition for investors who are interested in the income side of the equation. Now, I would argue that over the long term, we're probably facing a multi-year super cycle in commodity prices and in oil gas prices specifically. And so I think that the level of yield you're going to get out of a name like Pioneer or Chesapeake Energy is going to be impressive relative to a risk-free rate. But in the short term, that is a consideration that some investors have. Why go out the risk curve and buy an operating company, an oil and gas operating company, when you can buy a risk-free treasury bond and get a yield north of 5%.
I think the other thing that higher interest rates are causing, they're causing a lot of investors that may have invested in some of these wells for private drillers in the Permian Basin. So these are companies, for listeners out there, that are not publicly traded. They might even be a partnership vehicle or some type of limited liability company. They're not publicly traded. They're not large enough. They don't have access to capital markets to go and get either cheap debt or sell corporate bonds or things like that. So these are privately traded. They're private companies that are not publicly traded. And so their cost of capital is going to be a lot higher, and dependent upon investors who are going to look at the things like you said, they're going to look at, well, why am I taking the risk of drilling these Permian Basin wells that are shale wells that could deplete rapidly, and the return might not be as good when they can get a risk-free return in US treasuries or money market funds. And I think because of the higher cost of capital, Elliot, the people that are running these private companies that are not publicly traded, or the partnerships, they just decide over the last 35 months to sell out because they don't know when interest rates are going back down. So you've seen like the EOG Resources, Pioneer Natural Resources take advantage of this in the last 3 to 5 months and just go and scoop up some of these producing wells at pennies on the dollar.
Well, yes. I mean, there's a number of different factors going on there. The cost of capital is certainly a motivating factor. Some of these private companies are basically backed by private equity, right? So they're heavily leveraged relative to, as I said, a name like Pioneer, very, very little debt, right? Mostly financed through operating cash flow. That's not true with a lot of these private companies. They do have to borrow money to fund drilling. There are other advantages too, though. One of them, I think, that's very important is access to infrastructure. So a name like Pioneer, they have access to pipelines, right, to move their oil and natural gas to market. This is absolutely critical because, if you look at natural gas prices around the US, at the beginning of today's talk, you talked about the price of West Texas Intermediate and the price of natural gas. And the price of natural gas we all look at, right, is the price at the Henry Hub in Louisiana, which is a trading hub in Louisiana. But there really are dozens of different prices for natural gas in the United States. You go out to the Southern California gate, right? It's much higher than the cost of gas at Henry Hub because there's just not enough gas in that market. It's an undersupplied market. If you look at a place like West Texas, right? Or the Northeast or Pennsylvania, for example, the Leidy Hub, you're going to find that gas prices are lower in these markets. And so, a company that has access to pipelines to move that natural gas to those hubs or areas where prices are much more favorable, where gas is actually in demand, for example, the Gulf Coast, they have a natural advantage. And it can be expensive for a company to buy firm transportation capacity on a pipeline. And of course, these bigger companies that have more volume, they're the ones who have the best access to takeaway capacity. Another big one, which on a number of conferences I've been to over the years, it was a hot topic, is water, right? So in shale, you have to use hydraulic fracturing to make those wells economic. And hydraulic fracturing is essentially a process of pumping water into a reservoir under tremendous pressure, mixed with sand and certain other chemicals, but it's primarily water. And literally breaking up, fracturing the rock, creating a pathway for the oil or gas to flow through the reservoir rock itself. Oil and gas are not in some sort of giant underground cavern that you pump out of. They're actually trapped in the pores and cracks and natural crevices of those underground rocks of the reservoir. It takes a ton of water to do this. And these wells that companies are drilling nowadays on both the oil and gas side, you're talking about miles long lateral segments, horizontal segments that are fractured in multiple stages. And so in many of these places around the US, fresh water is in tight supply. For example, West Texas, right? Pretty dry area. Having access to water, the ability to take water that's coming back out of a well, recycling it for reuse, right? This can make critical, dollars a barrel worth of difference in terms of your cost. And so your bigger companies like a Pioneer, right, or an EOG is going to have access to that kind of infrastructure, either owning it themselves or, long-term contracts at favorable rates. And that's a huge advantage relative to a smaller company that has to pay a third party to do that work for them. So infrastructure is important on all those things. Other things like natural gas processing, basically taking raw natural gas and separating things like propane, ethane, and butane, what we call natural gas liquids, from that raw natural gas stream. Separating carbon dioxide that's naturally occurring in gas in certain parts of the country from the natural gas stream. All of these things are expensive, and the big companies have advantages, natural advantages in terms of those costs. So what we're seeing is I would kind of call it two different types of acquisitions. You have the big companies like the Pioneer and the EOG, and mainly they focused on smaller deals, smaller packages of wells that they're buying up. And a lot of times it's because, first of all, they have a huge cost advantage over the small producer. But also, companies like Pioneer and EOG, they also want to make sure they maintain their drilling inventory. I think a big issue you're going to hear more about over the next 5 to 7 years is a lot of shale companies kind of running out of their prime acreage. So their prime drilling locations, the lowest cost drill sites for producing oil and gas.
It's called Tier 1, right? For listeners who want to look it up.
Yes, Tier 1 acreage. It is, most of these companies, if you go and you listen to their calls or go look at their presentations from their last call on their websites, you'll see that they quote, how many drilling sites they have in each of their tiers. And, a lot of what they're working on, for example, is say, how can they take what's considered a Tier 2 drilling location and maybe design the well differently and turn it into more like a Tier 1 type of location. But it's very important to have these locations and have an inventory of them that can support your drilling activity for many years in the future. And, you think about a company like Pioneer, they actually try not to grow their production, even when commodity prices are favorable, at much more than around 5% a year, because if you think about it, the more they drill, the faster they run through that inventory. So I do think that's something you're going to hear more and more about as these companies run out of those Tier 1 locations, that prime acreage, and start having to either drill higher cost sites or make some sort of an acquisition to sort of to grow out the acreage.
Sorry to interrupt you. Let's talk about that a little bit more. Isn't a lot of the Tier 1 acreage the last 10 to 15 years in the Permian Basin, hasn't a lot of it already been drilled and it's been depleted? Because if our listeners go out and read some of the books about fracking and hydraulic fracturing, I mean, they've gotten really efficient with the process with these octopus drilling pads, but all it really does is it pulls out the oil production even faster at faster and faster rates. So the wells deplete. Instead of many years, instead of 3 to 5 years, the well's depleting in 1 or 2 years.
Well, I mean, with shale, with conventional reservoirs, there's a huge risk. With a conventional oil or gas reservoir, there's a huge risk that if you drill too aggressively, if you drill too many wells in the same play, you can basically kill the productivity of the entire field. And the reason is because, oil and gas comes out of the ground because of natural geologic pressures. And so if you reduce those pressures too quickly, you can actually damage the reservoir. And that's a big problem with conventional reservoirs. With shale, it's a little bit different. It is, of course, possible to have what we might call communication between wells, where, a well drilled some distance away by you or a competing company might impact the pressures in your well, right? Because these are huge wells. And as you said, they this pad drilling, they drill down and sideways in all directions at all different depths. So there is some problem with that. Some plays, some parts of the Permian even have a bigger problem with that than others. Some companies have actually backed off their well spacing, so they're spacing wells a little bit farther apart to mitigate that problem. And what you've got left is you've got these large companies, the Pioneers and EOGs of the world. In most cases, I look for companies that have at least a possibility of continuing to drill at the current rate for 15 years or more. And I think with the better names like Pioneer and EOG, you have that. With some of the smaller players, I do think that's an increasing risk. They don't have a lot of places to go. in terms of, they don't have enough high quality drilling locations. It's particularly true in other plays. The Permian Basin is nice because it's a stacked play. There are multiple productive layers at different depths. Some of these other plays don't have they don't have as many productive layers. For example, the Bakken Shale of North Dakota. You're not going to have you're going to drill through your inventory faster in a play like that. It's an increasing problem, and I think part of the reason you're seeing these acquisitions from the big guys is they're trying to sort of beef up their acreage, knowing that eventually they're going to run out of these prime drilling locations. And then you have some smaller companies too, like for example, one name I follow a little bit is a company called Matador Resources. They're in the Permian. They're a smaller player. They're located in the Delaware Basin of the Permian, which is sort of the western reaches in West Texas and New Mexico. And they actually made a pretty big acquisition recently of a private company, but a large company. And that, in my mind, was totally a move about the big worry, the big pushback you heard about that name for the last year or two has been, they don't have enough inventory. They don't have enough prime inventory. And so they had to, pay up a little bit to make an acquisition to actually, sort of alleviate that fear. So I do think that's going to be a big issue you're going to hear a lot more about in coming years is, companies literally running out of prime drilling locations. And it's another reason why you're not going to see, if you look back from 2010 to 2020 or so, the shale business was in a boom phase, right? It was all about production growth at any cost. And since 2020, it's been much more muted in terms of production growth. And in my view, you're not going to see a return to those boom years again. Production will grow, but it's not going to grow at the pace it did previously because these companies, they're drilling through their inventory. There just aren't as many, there isn't as much fresh acreage. There isn't as much operational efficiencies to be extracted in terms of well design, fracturing design that there were in the early years. So you're not going to see the same kind of shale production growth that you did in that 2010 to 2020 phase. And, that's bullish for oil prices, frankly, because almost all the production growth outside of OPEC since 2010 has come from shale. I was looking the other day at data from the statistical review of world energy. It's now put out by a company called Energy Institute. Used to be BP Statistical Review. It was British Petroleum. But since 2010, non-OPEC oil production, excluding the U.S., has grown by 72,000 barrels a day. That's nothing, right? The world oil market's over 100 million barrels a day of demand. Global oil demand since 2010 is up more than 10 million barrels a day. Non-OPEC production outside the U.S. has barely moved over the last, 12, 13 years now. So, without growth from shale, we would be looking at a very different oil price right now. And, going forward, you're not going to have the advantage of that big surge in shale production to kind of keep a lid on prices. And that's another reason why, this all feeds into sort of, I think, a bullish longer term argument for oil prices.
Yeah, I totally agree. And I think we're going to see higher price floors for oil prices. And I think you highlighted why. I think number one right now, and I don't know how long the Fed's going to keep interest rates at these levels, but as long as they keep interest rates at these levels, and that's going to affect the private sector, the higher cost of capital is going to prevent a lot of new drilling. So for our listeners out there who are not familiar, there was almost 4,000 drilled but uncompleted wells that could have been brought online quickly in a matter of weeks, I think in 2020 and 2021, and by the end of 2022. Well, they're through that inventory. And so the oil service industry, the drillers, which is who like the producers, the exploration and production companies hire, if you listen to the conference calls for some of the small and medium-sized drillers and the larger ones, they're saying that Q3 of this year, Q4 of this year for 2023 is going to be very, very weak for drilling new oil wells in the Permian Basin. The rig count, Elliot, is already down. I know the numbers just came out today on August 18th, 2023 for this week. The rig count is already down 18% since the November 2022 highs. And based on what the oil service companies have said recently in the conference calls, it sounds like it's headed lower over the next couple of quarters too.
Yeah, and the gas rig count is also plummeting, as you might expect. It was down to, I think this week it was 117 rigs in the United States drilling for gas. Literally back in the end of April, early May, it was over 160 rigs, down to 117. The rig count in the United States is plummeting. And I think one thing that's a very important distinction to make is that right now, you can kind of divide the world into really two chunks, right? You have North America, which is pretty much shale, right? Mainly in terms of drilling activity. And then you have the rest of the world. And we're seeing a real bifurcation there. Shale is slowing down aggressively. Companies are cutting capital spending. Even Pioneer, right, which is a very high quality producer, on their last call, they actually cut their capital spending estimate. The only reason they're going to actually exceed their production estimate is they're just getting more efficient on using their capital. And part of that is that there are, as you said, a lot of the smaller drillers, a lot of the smaller services names in the US are basically giving them price discounts, right? Or they're not facing the same level of cost inflation they were, say, a year ago. So in the US, there's a problem in that business. Internationally, though, it is an entirely different story. Listen to a conference call from a company like Schlumberger, which is now just called SLB. They primarily get the majority of their revenue comes from outside the United States, around 3/4 of their revenue. And their U.S. business is primarily offshore, deep water Gulf of Mexico. And then you look at a name like Halliburton, they have a large international business. They also have a large U.S. business as well, but they have a large international business. Or Baker Hughes, which is another one. They derive, somewhere close to 70% of their revenue from outside the U.S. And the international business is literally booming. And spending is just going through the roof in a lot of different international markets. The Middle East being a real bright spot right now. And a lot of that's driven by OPEC, right? So you have countries like...
Didn't Saudi Aramco just announced earnings, right? And they're the most profitable company in the world. They actually surpassed Apple, I think.
Well, and I think they're in the catbird seat, honestly. And for the rest of OPEC as well, they have more power over the oil market today than they have since the early 1980s. And the reason I say that is that, as I said, nobody's invested in non-OPEC production for literally years. The top of the last cycle in terms of spending was 2013, 2014. And since then, spending collapsed and has remained very low, with the exception of shale, which, as we just talked about, it's already slowing for other reasons. And so nobody's drilled much in the way of deep water wells or offshore wells or gone out and explored for and found new sources of energy outside of OPEC, right? So the supply is stagnant, and OPEC can therefore control the price. If they don't have, if OPEC is the only place in the world that can, and by OPEC I mainly mean Saudi Arabia and a handful of other, Gulf of their close allies in the Gulf region. If they're the only ones that can increase supply on short notice to push down the price of oil, or pull back supply and push up the price of oil. And unlike, say, back in 2015, where shale was growing very rapidly, they don't have to worry. Pretty much no matter how high oil prices are going to go, you're not going to see this, 3 million barrels, 3 million barrels a day of growth outside of OPEC in terms of production. So they can push up and down the price with impunity. So, what happens this year? The Saudis come out and to say we're going to do a voluntary, unilateral 1 million barrel a day production cut. If we need to do more this fall, we'll do more. They have a lot of control over the global oil market again, which is something that they they lost control of the global oil market back in 2013, 2014 because of shale. And what they're doing right now, because they can see all this growth in demand, right? They're going out and they're spending on building up their spare capacity, their excess capacity to produce more oil. They're not doing that because they don't think it's going to be in demand. They're doing that because they know that global oil demand is still growing, despite some of the ridiculous headlines we heard a few years ago about peak oil demand globally. It's still growing, right? And that oil is going to be in demand.
Especially that demand. Let's talk about that demand. So that demand's not coming necessarily from the U.S. or other countries. It's coming from emerging markets. So countries like Vietnam, India, where people are not necessarily buying giant sport utility vehicles or even giant four-door sedans or anything. It's coming from people driving like motorcycles and electric scooters.
Right. And if you look at the history of the oil market, you can look at it on a per capita basis, right? And every country that's developed, whether you look at a country like Japan, right, or later South Korea, or now China and then India, right, they all start out with relatively low per capita oil consumption. But as the economy grows and develops, energy demand and economic growth are basically two sides of the same coin. You can't have one without the other. You cannot really grow your economy without, using more energy, whether you're a manufacturing country.
Well, cheap energy too. Yeah. Not just energy. You need cheap electricity and then you need cheap fuel.
Right. And, you look at a country like Germany, which has had very high energy costs lately and for years, really. And, their economy is really struggling. And you look at the data coming out of Germany in recent months and quarters, it's been quite weak. And a lot of that has to do with the fact that it's very difficult to do business in Germany because your costs are so high and energy is a huge part of that. It's literally everything as well, right? So it's also feeding your population. Agriculture uses a lot of energy, uses a lot of energy commodities to make fertilizer, for example. So it really is a pervasive issue. You have this growth in demand, and yet the world has not invested outside of OPEC in new production capacity. And I would compare this to the 1970s. And if you think about the 1970s, OPEC started flexing its muscles in the early 70s, 1973 and specifically. And oil prices started to go up in both nominal terms, but also in real terms, right? Inflation adjusted terms. And it wasn't really, oil prices didn't peak until the late 70s, 1980, actually, and start coming down into the mid 1980s. And the reason they peaked and started coming down wasn't that the world stopped, that demand for oil stopped growing. It continued to grow straight through the 70s, the 80s, and the 90s, right? It's because there were a lot of new sources of oil and natural gas later that came on stream in this time, because companies went out and poured a lot of money, capital spending, to develop, the Cantarell field in Mexico, Gulf of Mexico in the United States, the North Slope of Alaska, the North Sea of the UK and Norway. All this non-OPEC supply is what really brought prices down. That's what actually killed that energy price super cycle back in the late 70s, early 1980s, more so than any other factor. And you're going to need to see that this time in order to break the cycle of ratcheting higher energy prices. Because, in the absence of competition in terms of from other countries producing enough energy to meet demand, the Saudis are going to tend to set the price of oil at a level that's comfortable for them.
Well, let me also add with the OPEC, the rest of the country. So the Saudis might be pretty efficient at oil production right now, but the rest of OPEC, if you look at the OPEC plus numbers, they're nowhere near their production quotas. Their production's falling on its own. So the rest of those OPEC plus producers, they're not hitting their production quota numbers. They're not investing in CapEx. So really the one who's carrying almost all the weight with the efficiency, the free cash flow, the profits, investing, like you said, in future production growth, or at least maintaining capacity. Or I think the Saudis are replacing a lot of the guar production with a little bit higher cost deep water offshore wells. is only Saudi Aramco. The rest of OPEC Plus is not really doing as good a job. I think Russia just announced too another 300,000 barrel per day production cut, but they're having capex problems too.
Yeah, it's really Saudi Arabia, the United Arab Emirates, Kuwait. There are few core producers in that Gulf region who are they're quality companies. They can produce. They are spending money, but a lot of the countries, their quotas are basically fiction. You look at a country like Venezuela. They have no hope of producing oil at the rate they did 5 or 6 years ago. Their wells they haven't spent any money there. Obviously, they've had nothing but economic problems. Other countries like Nigeria are struggling under the same types of things. And I think there's a misconception in the mainstream media, perhaps, that these companies can a company could quickly go into a country like Venezuela and turn things around. That's not how it works. It would take many years of capital spending to actually turn around their energy business, and nobody's going to invest in a country like Venezuela, in the current political climate. So their production will continue falling. And that oil has to come from somewhere, and there are only a handful of places around the world, with the capacity to fill that kind of a gap. Certainly Saudi Arabia, some of those core Gulf states are one area. There are a few big plays being developed around the world, like Guyana, Exxon Mobil's project down there in South America. Brazil has some interesting plays right now. But, really, there's going to have to be another wave of spending on exploration and production in order to develop these new fields. And nobody's done it for so long. It's literally going to take years to get those projects off the ground and producing.
Yeah, I totally agree. So there's going to have to be oil production growth from outside of OPEC, but there's been a lack of investment for a long time. The other side of this, and you mentioned deep water, some of the deep water plays like Guyana, but if you look at some of the deep water companies, I think one of them, Seadrill, went bankrupt 2 or 3 times and it was restructured. So they've been through hell the last 6 or 7 years.
Yeah.
It's been one of the worst bear markets for Transocean and Seadrill. And I think the Diamond Offshore Drilling, I think they sold out the company after bankruptcy for assets for pennies on the dollar. So a lot of those older rigs, Elliot, they've been dry stacked, they've been scrapped. So even if there are new discoveries, there's not a lot of existing rigs to go and drill them.
Yeah, I mean, again, there's the advantage that the bigger companies have. So ExxonMobil, they made their discovery in Guyana, a decade plus ago, right? And they've been developing it over the last several years. And they poured all this capital into developing their infrastructure down there, securing rigs that are custom built just for them or custom to their specs, right? And the beauty of that, and this is actually what it's almost frustrating, this cycle, because the whole reason that we have companies like ExxonMobil, these super major oil companies, is because they have a low cost of capital. They're the ones that can actually afford to go out and develop these new fields during the down cycle for energy prices. If you went out, you said a few years ago, these companies were going bankrupt. They were cold stacking rigs. Services companies were cutting the costs for various services that are used to develop deep water wells, for example. So a company like ExxonMobil could get a really great deal on the services they need to explore for and develop these fields in places like Guyana, a low cost. And that translates to a low per barrel cost of production. And they were investing during the down cycle, taking advantage of that. And now they're reaping the rewards in the form of higher production. I'm not going to say they were unique in the business, but they were one of the few that actually did that. A lot of the other companies, the European companies, for example, what did they do during the down cycle? They cut spending. They tried to build free cash flow. A lot of them invested in a lot of sort of non-core alternative energy stuff, right? And therefore, they don't have an inventory of new fields, of major new projects that can power the next wave of production growth and cash flow growth for them. And that's a problem.
Didn't ExxonMobil also take on a lot of debt in 2020 when interest rates went lower? I remember reading the articles that and I was writing articles about this, that if oil prices didn't rebound, that they were going to have a lot of problems, but it's worked out for them. How much have they paid off of the debt on the balance sheet? What's their net debt down to?
ExxonMobil, there was a lot of talk back in 2020 that they were borrowing money to pay their dividends, because obviously at $25 barrel oil prices for Brent, right? You're not making a lot of operating cash flow, even if you're Exxon, and your cost of production in a lot of these plays. In Guyana, for example, some of their wells are profitable at $25 barrel Brent. So you're not generating enough operating cash flow to fund your growth. But what these companies have traditionally done is they have borrowed money, and back then they were borrowing money at a very low cost. They were issuing bonds paying a very low rate. And they were using that money to fund their operations, right, when commodity prices were low, but also continue to invest in all these projects that they were bringing to fruition. And I thought back then, I wrote about it, and I feel today that that's exactly the right move for a company like that. Now you look at them, and their net debt is down to something in the $20 billion range. I mean, we're talking about a company with a market cap of $450 billion, right? They really have paid down most of their debt. They're back to where they were in 2018, 2019.
Wasn't it hundreds of billions of dollars or something? They had like over 100 billion in debt. It was a astounding number.
At the peak, yes, they had, they'd taken on a lot of debt to maintain their dividend. That's true. They felt that,
their gamble, it was a calculated risk they took in 2020, and their gamble paid off.
Yeah, I think it was a logical risk, because, if you think, like I said, if you think about it, these big companies, traditionally they were about investing counter-cyclically. They were about putting money to work in new plays when commodity prices were low, knowing that ultimately commodity prices were going to come back up. And I think that the mistake a lot of these companies made, frankly, was believing that commodity prices weren't going to have another upcycle, which of course they have, right? And now they didn't do what they have done traditionally, which is invest in the downturn. They didn't, for example, buy up other companies like they used to do, in the down cycle at cheap prices, so that they have, more drilling inventory. And, Exxon, hats off to them. They took a lot of flack, if you remember, back then, about the way they were investing, borrowing a lot of money, about their lack of investment in, for example, ESG stuff, right? And alternative energy projects. And, it paid off for them, because, as is always the case with energy, it's a heavily cyclical industry, and ultimately the low prices beget higher prices, because when prices are too low for too long, supply drops, demand rises. Traditionally demand for energy drops during recessions, but it always bounces back. And down cycles are usually short-lived, because there's always some other country around the world where growth where energy demand is accelerating to kind of pick up the slack.
I also think their investments were very smart, because I was speaking with a petroleum engineer a couple months ago, Christine Guerrero, and she's worked for the big firms like Chevron and Schlumberger and Hess Oil in the past. And she said that the discovery in Guyana is probably the best oil discovery for deep water, many billions of barrels of wells, the geology, they keep drilling deeper down, finding new basins, that she thinks this is probably the best discovery in decades.
Yeah. I think it's almost undeniable that it's the best discovery anywhere, onshore or off, in at least this century. It's the size of it and the number of different exploration successes they've had. I think they've announced something like 22 separate discoveries on that one block in Guyana, the Stabroek block. And what they're bringing the projects on stream in phases. So the Liza phase 1 and phase 2 have come on stream. Later this year, there's another phase. It's going to be early Q4. called Payara, and that's going to ramp up to, I think, 260,000 barrels a day. They have another one coming on stream in 2025, and another one scheduled for 2026. And they've announced more discoveries that they haven't announced a final investment decision on, but you're likely to see even more beyond that. The size of the reservoir is impressive. The productivity of the wells is impressive, and just their development plan. They're literally bringing huge amounts of new oil production on stream at a time of, when the world desperately needs that non-OPEC production. And, it's very good for Exxon. And you mentioned Hess, they have a 30% stake in this project. And I think it's transformative for them because their other main asset is the Bakken Shale here in the U.S. The Bakken Shale is not as low cost as the Permian Basin. It's in North Dakota primarily, and it's the wells aren't as productive. The costs are higher. They are raising production there, and they hope to be able to plateau production around 300,000 barrels a day for about a decade. It's going to be very free cash flow generative, even at $50 plus oil at that level. But it's mainly a source of cash for them. It's not a long-term growth option. There just isn't enough there. There aren't enough drilling locations for them to really grow their production from that. But this Guyana play, which they have a 30% stake in, Exxon's the operator, is the amount of free cash flow that's going to be for Hess is literally transformative. I mean, we're talking about a company that's roughly 1/10 the size of Exxon Mobil. They're around a 45 or $50 billion company market cap, and you're looking at by 2027 or so, you're looking at $5 billion a year in free cash flow. By the end of the decade, it could be $9 or $10 billion a year in free cash flow. They've committed to returning about 75% of that to investors as dividends or buybacks. The companies that have invested in Guyana, I think, are going to see a lot of reward in coming years.
And if people go back and look at a long-term stock chart of Hess Oil, and I wrote an article on this for my patrons. So Hess Oil was fairly boring for many, many years. I mean, they didn't have any exploration successes. They didn't take a ton of risks. The shares basically, if you go and look at like a 20-year, 15, 20-year chart, the max chart, for most of those 10 or 15 years, the stock didn't do anything. It was in a small little trading range. Now the shares have broken out the last 3 or 4 years, and the stock, I think, is up almost 4x what it was in the past.
Right. Yeah. It was a sleepy, boring company. They did not have the best plays. They do have some other assets. I know they just announced I think it's called Pickerel 1 well in the Gulf of Mexico, which is an offshore well, deep water well, that they're going to tie back to an existing platform. So they have some small plays around the world, that are decent. But the jewel of the crown is Guyana, because not only is it going to ramp up free cash flow, most of these projects are cash generative, as I said, $25 to $35 a barrel Brent, but it's going to have a long plateau. These conventional oil field developments, once they get them up to nameplate capacity, they produce at a consistent rate with relatively low operating costs. Most of the cost is upfront capital for, literally 15, 20 years in some cases at a nice plateau rate. And I don't think we even know what that plateau is going to be, because they're continually announcing, it seems like, a new project to come on stream virtually every year. They just announced, I think it was maybe a month or two ago, or Exxon announced that during the whole COVID disaster, right, they had to kind of stop their exploration activity in there because they couldn't get the labor. They really couldn't pursue their business. So they negotiated a deal with the government there to extend their exploration license by a year. So they literally have an extra year to go out and find even more. And so I don't think we're even close to done in terms of discoveries there. And for Hess, I mean, the key is that for years now, literally since 2015. They've been pouring money into this play, this capital spending to fund all this development. And they haven't been generating any free cash flow until relatively recently. This year in Q4 with Payara coming up, I mean, it's going to be solidly cash flow generative. And then from here, it's just a gradual ramp over the next several years. They're talking about 25% annualized growth in free cash flow for years into the future. So it is an impressive play. And, Exxon's certainly a great company. It's my favorite of the super majors. But I think if you're looking at a play like that, I mean, I think definitely Hess has more leverage to it.
Oh, if the growth plans for the wells that ExxonMobil has announced, so 2025, 2026 that they've announced, what percentage of their annual oil production will Guyana make up for ExxonMobil then once those wells come online?
Well, they're talking about the plan now, I think, is the final capacity of it's going to be sort of 1.5 million barrels a day. By I believe the plan is for around 2027. Exxon, the way they kind of run their business is they do what they call high grading. So what they're doing is they're selling off older, more expensive to produce assets. So in many cases, these are projects which they've been running for a long period of time, and they're replacing those projects with low cost production from Guyana, where they might be selling an asset that is seeing declining production or has a production cost of sort of $40 a barrel, and then they're replacing that production with this really low cost $25-$30 a barrel cost Guyana production. ExxonMobil produces somewhere around 2 million barrels a day of oil. So it's going to be a huge chunk of their production. Now, of course, as I said, they will grow their production overall. They will probably continue to sell off higher cost assets, so their production won't grow exactly as much as they're going to get out of Guyana. But it's advantageous to them because their margins are going up. They're replacing higher cost production with lower cost production.
So they could potentially be up to around over 3 million barrels per day then, what you're saying? Because Guyana,
I think we'll probably get an update when they do their longer term, their sort of longer term planning, which I think they do every 5 years. Maybe it's next year that I believe it's next year that they're going to come out with that plan. But yeah, I mean, you could see of the majors, they have by far the best production growth story, bar none. I'm talking about the big super majors around the world.
Well, especially for oil, because Royal Dutch Shell, Chevron, they seem to be more natural gas focused.
Yeah. And that's important too. I'm not saying that's a bad thing because, the LNG, I think, is going to be critical in a lot of these countries, but.
The US is going to mint money exporting liquefied natural gas. So I know it's not energy efficient, but in terms of profits, I mean, it's just really profitable. If you can get the gas to a hub, to a pipeline, and then to a liquefied natural gas export facility and get Cheniere Energy to ship it, you're taking $2.20 to $2.50 natural gas and selling it to Europe or Asia at way higher prices.
Right. And those two countries, or those two regions rather, are going to be competing over, cargoes. So right now, for example, the JKM marker, which is the Asian marker for LNG, is a little higher than TTF, which is the tidal transfer facility in the Netherlands. So, LNG flows are going to favor Asia at the moment. But, if Europe is short of gas, say next winter or the winter after that, at some point they're going to be short of gas because they're going to have a cold winter again. Prices are going to have to spike there, and it's going to make it more advantageous to ship to Europe. So it's always nice to have, multiple sort of desperate buyers for your product. And that's kind of what you see with LNG. The amount of growth we're seeing in gas demand all over the world. It's the most environmentally friendly fuel in terms of electricity production. And it has an advantage over, obviously, alternative energy because it's not intermittent. You can kickstart a natural gas facility to feed in power when you need it. not just when, the wind is blowing or the sun's shining, right?
Well,
so
the other part of this is a lot of these countries are building liquefied natural gas import facilities, but they also have drilling bans domestically, so they don't want to produce the oil or the natural gas inside their own country, but they're spending very expensive capex to build a liquefied natural gas import facility. Meanwhile, there's opportunities for Qatar, Russia, Australia, and the US to just keep investing in liquefied natural gas export facilities because they have the domestic supply and then they could ship it. I think Qatar just announced a 30-year deal with China.
Yes, and you're going to see more of that, and it's going to be a very profitable business here in the U.S. I mean, of course, the super majors are going to benefit from that. Chevron, Shell, for example, have a lot of exposure to LNG. I do think in the U.S., the key region to watch in this regard is the Haynesville Shale, which is located down in Louisiana. And most of the LNG export facilities in the U.S. are either in Louisiana or the Texas Gulf Coast. And the advantage of that field is it's literally right there. So you don't have a lot of transportation costs to get your gas to those LNG export facilities. It's not as low cost as the Marcellus Shale, which is in Appalachia, but the transportation advantage is key. Getting pipelines permitted out of the Marcellus Shale is difficult. The big companies there, like EQT, for example, already have it, right? They already have access to that infrastructure, but it's harder to grow your production from Marcellus. Whereas, excuse me, the Haynesville Shale is right there on the Gulf Coast, near the Gulf Coast, and they can ramp up production there quickly if the price is right. And that's one of the reasons those producers in that part of the U.S., they generally are going to need, they're going to generally need gas prices to be sort of 354 and up in order to really make a lot of free cash flow out of their production there. And so I think that's why you're going to see U.S. gas prices get up to that region in coming years on average, up to that $4 plus region. Because that's what's needed to encourage incent development of the Haynesville Shale for LNG exports. And if you look at the U.S., actually the Energy Information Administration, up on their website, you can go there and see all the permitted LNG export terminals. And there's literally a huge raft of them coming on stream between the end of next year, the second half of next year, and say early 2026.
Well, I don't know. In theory, they're going to be built, Elliot, but with these interest rates, I mean, I think a lot of them are going to be delayed because the cost you're looking at to build one of these liquefied natural gas export facilities, billions of dollars. And with the interest rates where they are, if you're a small cap company trying to build a liquefied natural gas export facility on your own, I mean, you can't use debt at these interest rates.
Yeah, I mean, I'm only looking at the ones that are already under construction in the latter stages of construction. I agree. You're going to have. Again, I mean, gas prices are going to have to be.
Didn't Warren Buffett just buy one?
He's definitely invested in the energy infrastructure business. I think he's been early in seeing the importance of that, and just how crucial. U.S. gas production is going to be to the global energy supply chain. So I do think you're going to see some of these facilities are already close to finished. So you're going to see a bump up from just that. And then again, if interest rates are too high to make it profitable to build these and put them into service, you're going to have to see gas prices go up even more, right? To make it financially feasible for them to be built, because the level of difference between U.S. gas prices and European and Asian gas prices is so great. And it's going to be even greater in the future because I think you're going to have, right now, Europe had a really warm winter and they're okay right now. But it doesn't take much for Europe to be in trouble. They could have a cold winter. They could have, a summer where they don't get a lot of wind for their wind power facilities. Almost anything could set off. They're in a very delicate balance right now. So almost anything could set off another energy crisis there. And, I do think ultimately you're going to see a lot of these LNG facilities built, simply because it's going to be profitable to do so. Prices are so much higher abroad.
Well, the other part of this on the supply side, if natural gas prices in the US stay this low, a lot of the Permian Basin wells, a lot of the production mix, there's a good amount of natural gas in all the drilling. So as a byproduct, so if natural gas prices are low, that's going to mean less wells are drilled too, because they need a higher natural gas price, 4 or 5, in order for those wells to be economic. So you're just going to see a lot less wells drilled if natural gas prices are going to stay depressed in the US.
Yeah, I mean, there. Yeah, I mean, certainly that's true. I think that you're gonna have to have gas prices again. The thing with the gas market, with all commodity markets, really, is it's always about the marginal cost of supply. So as you said, in the Permian, we have what's called associated gas production. So all that means is that there's naturally some natural gas in the oil stream, naturally occurring in oil. And when you produce the oil, it bubbles out of solution, and you can sell it. Now, for an oil producer like Pioneer, it's basically a byproduct. And for many years, they were selling it at basically next to nothing because it's not really their target. And so the problem we had for many, many, many years during the shale boom for natural gas in the US was that in a normal commodity market, when the price of the commodity drops, you'll see less drilling activity. Like we were talking earlier about the decline in the US oil rig count, the decline in the natural gas rig count. And that will bring about lower supply, and that'll help support price, right? But with natural gas, it was broken because you had this supply that was going to come on regardless of the price of natural gas. It depended on the price of oil. So for many, many years, you had this broken market where the supply side of the equation was independent of the price of the commodity itself. In other words, it was based on oil prices, not gas prices. That has improved mainly because of the slowdown in growth from the Permian. And so now what you have is the cheapest natural gas in the United States is going to be the Permian gas that's associated gas. So again, it's a byproduct of oil production. And then you're going to have, the Marcellus shale. A producer like EQT, they can make free cash flow even in the low twos, a million BTUs. But when you get to a certain level of gas that can be produced from the Permian and from the Marcellus, you have to move up to increase your production beyond that. You have to move up to higher cost plays. And right up there, just above the Marcellus, is going to be, your higher quality Haynesville shale producers. And so I think what you're going to see in coming years is that, associated gas production from the Permian plus Marcellus, those two sources of gas alone aren't going to be enough to meet U.S. demand and U.S. export demand. And so you're going to have to see the price of gas get up to a level that allows some of those higher cost producers in places like the Haynesville to be profitable. It's the Marcellus is pretty much always going to produce gas, even at low prices, because it's so cheap to produce. But the function of the commodity market, and I think one of the reasons why gas is so volatile, is the price has to adjust higher to incent production from these other fields. And again, I think the volume needs to be there. And so the price is going to have to get there. And you're seeing it in the futures market right now, right? If you look at the price of gas futures, the curve, right? There's a seasonal effect, right? The gas prices are usually higher in the winter months than the summer months. But unlike, say, 2020, where the gas price curve was flat for years in the future with just this seasonal variation in price, it has a distinct upward slope. So the price of gas now is low because there's too much gas in storage. But, next winter, for example, U.S. gas prices for delivery in January or February of next year are much higher than the front month. And if you go out to, say, the winter of, 2024, 2025, you're up north of $4 a million BTUs. So the market sees that there's going to be a need for prices to go up to incentive, drilling from these slightly higher cost plays. You've got companies like Chesapeake, right, who operate in the Haynesville, they're already hedging some of their production at these much higher prices, far out towards the end of next year. So, I do think that's that's going to be a good business for them. And these stocks have done pretty well over the last several months. If you look at a name like Southwestern Energy or Chesapeake, that was very depressed. These are Haynesville producers, very depressed back in, say, February, March. Or even a company like EQT, which is a Marcellus producer, very depressed price back in March. They have rallied quite a bit. I still think there's more upside. Looking at just doing a simple, discounted cash flow type of analysis at a $4 sort of average price for gas over the next few years. I still see 30 to 50% upside in some of these gas producers. It's not quite the deal it was, 6 months ago or 5 months ago when prices were, the front month was down under $2 a million BTUs and gas was, basically out of favor as a result. But I still think there's some juice there. I'm becoming more bullish on oil now because we're seeing that unless there's a collapse in demand, and I'm talking about the level of collapse in demand that we saw in, say, the latter half of 2008, the world in Q3 and Q4 of this year is going to be undersupplied of oil. And the Saudis are restricting production. They're producing way less than the market needs. Oil inventories are going to come down. We've eviscerated the Strategic Petroleum Reserve in the U.S. So there's no way we can, just release more oil to keep prices down. I think prices are going to have to go a lot higher ultimately. And I'm talking about, we're going to probably see average oil prices in coming years sort of north of $90 a barrel.
So higher price floors, the new normal's not going to be cheap oil, cheap gasoline. I mean, even when the oil price was low 6-8 months ago, there wasn't cheap gasoline in most of the United States, although that wasn't free market. I think a lot of these states and counties and stuff like that were adding on all these extra gasoline taxes, especially in states like California.
Yeah, and we also have that's another aspect of that I think is sometimes overlooked is the refining side of the business. We lost a lot of refining capacity here in the U.S. during 2020, 2021, because a lot of these refineries aren't profitable to operate at the low energy prices we had back then. And so, there hasn't been a new refinery built in the United States in decades. And so some companies have expanded their existing operations, but there hasn't been a major new refinery built in a long time. And there just isn't enough refining capacity at peak demand.
Well,
and so, the refining margins have also been at times very attractive.
Well, it's not free market. I would say it's not free market, though. That's preventing the new refineries from being built. It's the politicians, the bureaucrats, the regulators, the environmental lawyers who are saying we won't allow new refineries. So that's why the companies are expanding the existing ones, because they can't get permitting or approval from all the regulatory agencies or the lawsuits from the environmentalist lawyers to actually build one. But correct me if I'm wrong.
That's absolutely true. And, each and different parts of the U.S. also have different gasoline blending standards. California's, for example, you mentioned, as you might expect, is kind of notorious on this. And, traditionally, California had refineries located on the coast that made gasoline for use in the California market. But it's not profitable to operate in California, right? So they don't.
Didn't they force some of those refineries to shut down? And the state of California also puts a really high gasoline tax. I think they make more money, the state of California does, on each gallon of gasoline sold in the state than the refining companies and the companies like Exxon Mobil and the gas station owners do.
Yeah, I mean, and it's that, and they also have a unique standard, which a refinery can't just switch standards of making blended gasoline, for example, on a whim, right? It takes time to retool the business.
It's seasonal, right? Don't they normally adjust? It's summer and winter blends, and that's pretty much it.
There are summer and winter blends pretty much everywhere, but in California, they do have additional requirements for gasoline sold in the state. And so producing California blend gasoline is harder. It's more difficult to supply. So it's a real problem. I mean, one thing that is kind of amusing that they've done at times is there are refineries in places like Washington and Oregon that literally refine oil and put it on a tanker and ship it down to California because there's not enough pipeline capacity to move gasoline around the state of California. So yeah, you have regional pockets of vastly different gasoline prices, and a lot of that has to do with, as you said, regulation, opposition to building new infrastructure, right, and literally forcing closure of infrastructure, not allowing new pipelines to be built, for example, to carry, say, natural gas or oil or gasoline or diesel into your state. And so that's certainly a problem. I do think it presents opportunities for because if you think the U.S. is bad, Europe is even worse. They've closed down more refining capacity in the last few years than we have. They're literally dependent on gasoline and diesel being exported to them at times. And so the U.S. refiners that have high quality operations in a place like Texas, they have a lot of flexibility long term to serve all these different markets around the world. They can, import oil if it's cheaper to do so. They can use domestic U.S. oil if it's cheaper to do so. They can supply the domestic market if it's more profitable. They can supply Europe, right, if need be.
The laws changed a couple of years ago, so the refiners were allowed to ship out the gasoline to Europe at a higher profit. I think they had those laws changed.
Previously, the refiners were you were allowed to export gasoline and diesel, but you weren't allowed to export oil. So
only finished products then. Okay.
Yeah, there was a lot of sort of arcane rules around U.S. energy production. A lot of it was protectionism. Another famous one is the Jones Act, which was actually passed by Seattle businessmen who wanted to control the trade with Alaska back in the early 20th century. And the idea was that in order to ship on a tanker, on any kind of a ship, right, any kind of a product between U.S. ports, you had to have a ship that was built in the United States, crewed with Americans. I can't remember all the requirements, but basically it was a scam.
They're ridiculous. So basically then the LNG tankers that are coming out of the Gulf of Mexico, then they can't move the LNG tankers to the Northeast, so the Boston area, and offload it there. So because a lot of the liquefied natural gas companies, for our listeners out there, are actually they're headquartered in the Caribbean. So on paper, they're Caribbean companies, even if almost all the employees are Americans. Right.
Yeah. So so there's these artificial restrictions, and it's sort of one of the most Byzantine businesses in that respect, right? There's all these odd regulations and sort of impediments to doing business in various parts of the country. But yeah, I do think that, longer term, a high quality refiner, a name like Valero, for example, has Gulf Coast refiners, can handle a lot of different types of crude oil. They're operating in, let's face it, a very friendly state towards energy. They can export, they can import, they have a lot of flexibility. It's not quite as advantageous for, say, a landlocked refiner, a refiner in the interior of the United States. Doesn't have the flexibility to, say, export or import gasoline or oil for their raw material. But I do think for those names, on the Gulf Coast, I think Valero is probably the best. It's the largest, best known, but they're going to benefit longer term from attractive refining margins, what we call crack spreads.
Don't the refiners actually benefit when oil prices are cheaper, or does that not really benefit them?
Yes, it does. The crack spread is a measure of refinery profitability, and it's basically just an indicator. But the most common quoted one is what we call the 3-2-1 crack spread. And so what it is you take the cost of 3 barrels of crude oil, West Texas Intermediate crude oil, right? And a refiner, they're a manufacturing business. So crude oil for them is their main raw material. So they buy 3 barrels of crude oil, they sell 2 barrels of motor gasoline, and 1 barrel of ultra low sulfur diesel. And so you can get an idea what their profit margins are like by comparing the cost of 3 barrels of crude oil to the value of 2 barrels of gasoline and 1 barrel of diesel fuel. The other one, which I'll just mention in brief, which I think doesn't get enough attention, is that the refining oil is primarily about heating it up and cooling it down. So when you refine oil, you raise the temperature of oil, and by doing so, it separates hydrocarbons of different weights into different heights within the distillation column. And it requires a lot of heating things up and cooling things down. And the main fuel for doing that is natural gas, right? Primarily, that's the fuel for doing that. So US refiners have a huge advantage there as well, because natural gas here is much cheaper than in, say, Europe. So there were times, for example, last year when natural gas prices were very high in Europe, they literally couldn't refine profitably because the cost of natural gas for their operations was too high and prohibitively high. Meanwhile, of course, the US refiners are minting money with gas at a fraction of the European price, even at the highs. So that's another factor that I think is widely overlooked. Yes, oil is the most important raw material. Refiners do benefit from falling oil prices, provided that gasoline prices, and diesel prices remain high. But U.S.
and demand doesn't collapse. Yeah, so that's the main thing there. So if they have cheaper for our listeners out there, if they have cheaper input costs, so cheaper oil prices, and demand for gasoline and jet fuel and diesel are still high, then the miners, their profit margins are going to be enormous because their costs are going to be lower and they could sell the product at higher prices.
Right. And and they're going to generally, US refiners are going to generally be more profitable than most of their competitors because they have cost advantages, both in the form of cheaper oil from here in the US, because US is a major oil producer, but also that cheaper gas. I think is something that's widely overlooked. And, as bad as U.S. regulation has been in some states, particularly, Europe has been even more aggressive, and they've had to close a lot more capacity.
Yeah, Europe's super heavy ESG. I think they're suing Exxon. There's like suits and counter lawsuits for ExxonMobil over ESG policies in Europe. So I think they're going after the U.S. oil companies for the European operations.
Yeah. Yeah, and that's a headwind, but ultimately it's a headwind for the countries, and it's a support for oil prices, because the price of oil is going to the price of oil, gas, all these commodities is going to have to adjust higher to offset these artificial costs. Ultimately, what they're effectively doing is creating more inflation for themselves. Because if it's too expensive to operate in Europe, you're going to have less capacity, whether that's refining, natural gas, power plants, whatever it might be, right? If it's too expensive to operate, companies are going to close down capacity, or they're going to charge higher prices to offset those, legal costs, et cetera.
Well, outside of drilling in the North Sea for Norway has production growth and liquefied natural gas export growth, and the North Sea oil production for England is trending downward now. I mean, I know it was growing for a while, but for decades, but now it's trending lower, much lower. So a lot of oil and natural gas production in most of the European Union is trending downward, except for, I think, Norway.
Yeah, and Norway they were not going to develop some of their Arctic fields. But now they're revisiting that, and they're talking about developing some of those Arctic fields, because they have enough in northern Norway, right, in the Barents Sea. They have there's a number of discoveries, and it's fairly high cost to produce from that region because it's a harsh environment, but there are also some impressive size plays. So I do think you're going to see more of those developed, because Europe frankly needs all the energy supply it can get, and the more it can get domestically, the better off it is. And that, by the by, that kind of brings me to another point that I think is a common misconception. I talk to a lot of people who think that, the reason oil and gas prices were high last year, particularly oil, is because there was a disruption in Russian oil supply. In fact, the opposite is true. Russian oil production went up last year. They sold a lot of oil at discounted prices to China and India, and they sold less oil to, the European Union primarily. The reason they did that is that, when a country is facing high military costs and they're an energy producer, the first thing they turn to is oil export revenue. So the reason oil prices went up last year didn't have much to do with Russia at all, even though I know
Wait, are you talking 2022? Or, okay.
2022 last year.
Okay, they peaked out towards the end of 2022. Okay.
Yeah, there's going to be a knee-jerk reaction when something like that happens because of the threat of potential supply disruptions. But when the figures are actually in, Russian oil production was actually very robust last year. The sanctions imposed on Russia didn't really affect their ability to export to countries like China and India. So the actual volume supplied to the global market really was not negatively impacted much at all. Oil prices went up last year mainly for other reasons. Simply put, that demand was relatively robust, the recovery from the COVID lockdowns, and at the same time, supply from all over the world was insufficient to meet that demand. It was a very tight market, but it wasn't really just. In other words, the spike in oil prices we saw in the immediate aftermath of the conflict probably was a psychological impact of the Russian invasion, but the actual volumetric impact on the market, I think, is overstated. There are deeper problems there than just the Russian supply disruption.
Yeah, there's been a lack of CapEx investment, as we highlighted much earlier in the interview.
Right.
The other major reason I think oil prices crashed, besides the geopolitical risk premium coming out maybe from Russia invading Ukraine, was the strategic petroleum reserve sales. So do you think then, as the strategic petroleum reserve sales either slow down or stop, that's going to prevent price pressure on the oil price?
Yeah, that's a huge thing because, I don't think that the Biden administration would have had the political capital to release that much oil. We released a record amount of oil from the Strategic Petroleum Reserve. I mean, we've eviscerated it. It's back down to levels we haven't seen since the early 80s, right? So 40 years ago. And the reason that they were doing that is because they were saying, well, the Strategic Petroleum Reserve is supposed to offset short-term supply disruptions, right? Or supply disruptions in the global oil market. And they were able to say, well, the Russian invasion is causing a global disruption in oil supply. And therefore, we're going to release from a huge amount of oil from the Strategic Petroleum Reserve, more than we've ever done before. At times, it was 1.5 million barrels a day. But the reality is that that was kind of a fig leaf, if you will, an excuse, right? The reality was that there were really other factors.
There was the November 2022 congressional election. So I think that's the main reason, because what the voters said was they're worried about the economy, worried about the inflation. The average consumer out there who's not affluent, if their food bill's going up, their gasoline bill's going up, their electricity bill's going up, their standard of living is going to collapse. So I think there was intervention there with the Strategic Petroleum Reserve sales prior to the congressional election.
Right. And I mean, I think that would be, I think that was the obvious reason, but the Russian invasion kind of gave a convenient excuse, if you will.
Cover story,
Right. And, I don't know that they would have been able to release that much oil from SPR had that not been the backdrop. And so in that sense, it was another reason why, the Russian invasion was actually kind of bearish for oil ultimately. But to answer your question, I mean, from current levels, at some point, the SPR drops so low in terms of the quantity of oil in it that the market starts to be concerned with two things. First of all, our inability to respond to a real supply disruption, right? Say, for example, the military needs access to oil, right? Or that eventually we're going to want to replenish the strategic petroleum reserve, which of course means that demand is going to go up because the government's going to have to buy oil to put it back in there.
Well, they've kind of balked at that. They said they were going to start buying, but then they didn't because they said the price was too high and they wanted to wait. I mean, there's been a lot of misinformation and lies and spin coming out of the Biden administration about when they would stop selling oil from the Strategic Petroleum Reserve. I've seen oil experts like Art Berman still claim that Strategic Petroleum Reserve oil sales stopped in November 2022, but there's a ton of articles saying that they were still dumping 26 million. I think they even dumped around 26 million barrels of oil onto the market in February or March of 2023. So they were still selling.
Yeah, they still are. And in fact, they were saying last year that they wanted to buy oil. I think it was under 70 or 72, maybe. I can't remember the exact number, but there was a time earlier this year where the entire oil curve, for years in the future was under the price where they said they wanted to buy oil. And, we didn't see any oil really added back to the SPR. I think it increased by 1 million barrels a couple of weeks ago. I'm not even sure why, but
so
there hasn't been significant.
Okay, so what you're saying then is they could have started buying a lot of oil for the Strategic Petroleum Reserve when the prices were below the number that they said they were going to buy, but then they didn't.
Right, they didn't, and one reason for that is they don't really want the price of oil to go up, right? But the point is, at some point in the future, we're probably going to want to replenish it, and so at some point that means that the additional supply we enjoyed last year is going to have to be, actually lower supply, and the idea is that theoretically, if the disruption were a short-term issue and the price of oil were high just because of a short-term supply disruption, then you would assume that once the supply disruption was alleviated, the price of oil would come back down and you could buy it at a good price. But in this case, it's actually the reason oil prices were going up wasn't a short-term supply issue. It's a structural supply issue that we just talked about, the lack of investment. So, and
then the older wells are depleting. So, and then we don't have clear-cut answers for what's going to offset the depletion.
Right. And, and so I don't think the price of oil is going to, you could certainly see dips, right? Recession, whatever. But I don't think the price of oil is going to sustainably go down to the levels they're talking about wanting to buy it for potentially years.
Well, if they do, I think the Saudis and OPEC will announce cuts, and then I think the rig count will continue to fall. So then I think the supply side will act accordingly, especially with interest rates at these levels. So you'll just see a lot of the producers just say, okay, well, if the prices are this low, we're cutting back on supply, we're cutting back on CapEx, we're cutting back on drilling, and then the problem will correct itself in a couple quarters.
Right. And and if the Saudis obviously weren't happy about the U.S. releasing all that oil from SPR, and the United States came out and said that they were going to replenish it, and then they didn't. And, so the Saudis obviously weren't very happy about that either.
Well, the Saudi oil minister said even worse. He was actually accusing the U.S. and the bankers of creating excessive amounts of paper futures contracts to short the paper price too. So it wasn't just the SPR sales. He was saying that the paper market in oil is manipulated and rigged. He said that earlier in 2023.
Yeah, and they've proven that they can certainly make it very painful to be short oil, because they kind of relish in these surprise production cuts. So I don't think that you're going to see a huge amount of extra supply from SPR because there's just not enough left in there for it to be sustainable. But I also think that, I think longer term, the concern is going to be the U.S. is going to want to replenish it at some point, I would assume. And, the market's going to worry that when they do that, they're going to be buying it at higher prices and, actually forcing the price of oil up. Right.
Well, unfortunately, I don't think we're going to see legitimately sizable SPR purchases until 2024 or 2025. Whoever's in the White House next, we'll see right. Who's in the White House next and who controls Congress. But unfortunately, with energy policy, stuff that makes a lot of sense is pushed back or delayed. So I think the next person in the White House is probably going to be the bag holder having to deal with this mess.
Yeah, I agree.
Well, I really enjoyed our discussion today, Elliot. I've kept you for over an hour. I feel like we can go for another hour or two, but I think my listeners, it's over an hour. This is a wealth. You are truly a wealth of information about oil and natural gas markets, and I enjoyed our conversation today. My listeners want to take a look at your newsletters, your different ones. How do they do so?
Well, I have our flagship energy product is Energy and Income Advisor. So it's energyandincomeadvisor.com. And we have a model portfolio there of a bunch of different energy stocks. We cover everything from producers to refiners to the oil services names we talked about a little bit. In addition, if you want to get some free commentary that I do have a Substack that's called the Free Market Speculator. So it's substack.com, and you can look up my name or the Free Market Speculator. And most of my commentary there is free. I post twice a week on Tuesdays and Thursdays. I would say about half the content up there is specifically energy related. So if you're interested in some of the trends we talked about today, sort of an update on what's going on in the oil markets, I do post a lot of free content there as well.
And I'll attach links to your Substack, your newsletters, and your Twitter in the information and description section below the video. Just want to thank you so much for...
Thank you very much.
Yeah, I really enjoyed our discussion today. Actually, I always enjoy our discussion. Our listeners get a lot out of it every time I interview you.
Oh, I really appreciate that. I always enjoy doing it. And, I'd love to, if any of your listeners want to send me a tweet or whatever it's called these days, I'm always happy to respond. And I do have an email on my Substack if you have any follow-up questions.
Are they going to start calling it the artist formerly known as Twitter?
Yeah, it seems like it, doesn't it? I'm not even sure what you call tweeting anymore, but
they just labeled it to posts and retweets for now. But I mean, like, he's talking about eliminating blocks, and I mean, like, I'm paying monthly for Twitter Blue, but it seems like my follower count's falling, and hardly anyone's interacting with my tweets. So it just doesn't seem like it's that good of an investment to keep paying monthly for Twitter Blue if that's going to happen.
Right, it's definitely changed.